Yes, we
Yes,
can
loud
hear
and
you.
clear.
All right. Does that mean everybody else can hear me?
Yes, we can hear you.
All right. Very good. All right. Good morning, everyone. Welcome to the American Chamber of Commerce webinar this morning. On behalf of the American Chamber, I would like to welcome you all to today's webinar on Uganda's Tax Amendment Bills 2026. As you're aware, the tax policy remains the most critical level that is shaping the business environment. The proposed amendments this year carry a significant implication on investment decisions, operational costs, overall private sector competitiveness in Uganda. So at AmCham Uganda, our role is to ensure that the voice of our members is not only heard, but also meaningfully reflects in those policy decisions. So today's session is therefore an important platform for us to unpack proposed changes, understand their critical impact on businesses, consolidate evidence-based recommendations to be represented to policymakers. And we are particularly pleased to bring together experts in the industry, the leaders who will help us to guide the conversation and provide clarity to the amendments. So our partners from Forvis Mazars would like to thank you so much for this opportunity that you decided to work with us to be able to give clarity to these aspects. So I encourage all participants to engage actively. Please share your perspectives, raise your concerns or suggestions if there might be. And on that, we would like to start off and say thank you for joining us. If you have questions for now, we'll go through the presentations. After going through the presentations, we can be able to take questions. Make sure you note all those questions that you might have, all the concerns you might have, and any contribution that you would like to make at the end of the day for this particular webinar. So would like to thank you so much. And I would like to welcome our partners. Major, you'll be able to introduce your team to be able to that are going to help us to go through this. So please take over.
Thank you very much, Eve, for the introduction. And also would like to thank you for allowing us to talk to the big community of AmCham and all the other chambers. We are thrilled to present to you and also enlighten and maybe discuss and also hear from the rest of the community what is the main challenge people may be facing regarding the tax amendments that they've looked at, they've had. So for now, one of the biggest items that we need to maybe address is going to be walking you through the tax amendments. And we have almost all the we've arranged all the tax bills together. So in attendance or for the presentation, it's going to be myself, Major James Mutabaazi, my colleague Rita Nalubanga, who is a senior tax manager here at Forvis Mazars, and Patricia Namsoke, tax senior here at Forvis Mazars. So we're going to take you through all these amendments, and hopefully you get to get a key takeaway in terms of the planning for the things you want to achieve when you run the businesses, or to plan and see what you can do to mitigate any challenges. So also for context, we are not we're not really going to be bashing the government. We are only going to share the views so that for context, later on, anyone should be able to come back and say, if these are the amendments that are going to be passed, what is the implication? So we hope you enjoy that and also ask the questions. We don't also make the laws, as you will imagine. So where you feel the law is not clear, we may actually share the same sentiments, but also we would also like to get your feedback and see if we can address some of the queries you have. And then for the bigger part, we can then guide you in terms of what we think is going to be more reasonable. The discussions we do have here, I also shared with the parliament at some point, so they actually form very good feedback that the government can use. Some of it is considered, some of it may not be considered. And also, some of the items we're going to discuss today Since they are only bills, some of them may not see the light of day, others will. So in this case, we're going to now go through one by one. Some of them are good, some of them you may say these are tough. So you'll be letting us know where you feel you need maybe clarity, you need guidance. Feel free to drop the questions in the Q&A section. We shall be responding to those too. So I'll start off with the income tax amendments.
Major, just maybe to add off on what you just said, just a little bit. So some of these amendments that we will see that are too effective to the businesses, the chamber is going to aggregate some that will be presented to the policymakers, that is at the parliament, to see how and make the recommendations that we think that would be appropriate for the policymakers to make decisions on. Like Major has mentioned, some might be adopted, some might not be adopted, but our role is to make sure that we've given the right recommendations and that we believe that the business environment really needs those amendments to be put in place or some to be dropped. So thank you, Major. Please continue.
Thank you very much, Eve, for that. So we're going to start off with the changes. One of the first changes that you'll notice if you've been following is going to be they've introduced the word software to the definition of royalty. So this looks like a simple change for a regular reader, but what this means for anyone who is been buying software or paying software to international suppliers, this is going to affect you. How it's going to affect you? Previously, if you're buying software, you are able to categorize it vaguely as let's say a digital services as a digital service, and that way you're able to get at least tax being charged at 5%. Now that is now changing. They are trying to provide clarity that if it's digital, if it's going to be a software, the software has to be categorized as royalty. So the definition is adjusted to improve this. Now that is okay. Apologies. Let me just confirm that my presentation mode is clear.
We can see it, Major. Everything you're displaying, we can see it.
Thank you. Thank you very much. I've confirmed with the IT team that everything is fine now. So as I was indicating, they've introduced the word software into the definition of a royalty. What this means is that previously a software was considered as a digital service, and for some reason you would benefit from a lower tax rate, which was a 5%. Now, when they remove it and place it under royalty, it means your software is going to attract withholding tax of 15%. Now, they've done it in a way that is going to also cause a bit of problems. Why? When you look at the two categories, where they've removed it and where they're placing it, the two places seem to still be contradicting each other. So royalties are obvious, we know, and they've introduced now a 15%. However, a software, let's say Microsoft 365, is going to be considered as a software by very many people. But also, if you talk to the IT guys, they will tell you that Microsoft 365 is a typical cloud service, and it's provided as a medium, as a software, which is provided through a software. It's provided through a medium which is called software as a service. So technically, it means this change, if it's not rectified to clarify the limitation of what a software is, which sort of software and which medium it is going to be administered, it's possible some items are going to fall under cloud service, others are going to fall under software, and people will end up choosing the one that is least expensive, which is going to be the digital services tax. So that is something that is changing. So anyone with software be on the look. And also, my colleague is going to take you through the impact on the VAT. So there is one impact on the income tax for the software. We shall also see how it's been impacted on the VAT. Then the other change that has come up is the one on the change of this in the change in the people who've been disposing and accounting for property income. Usually they were looking at business assets. Now, business assets were described and defined, which was meant to cover any asset that you own and use in a business. I.e., if I own, let's say, a car and I'm a company, it means the car is a business asset for the company. Now, that's the definition that we previously had. Now, they're changing the definition to include both business and non-business assets. And the income that comes from a disposal of a non-business asset should be considered as income that you can tax under property tax. Now, the challenge with that is that there is no definition of what a non-business asset is. If you don't describe or define the non-business asset, it means when I sell my watch today, I should be able to come back and say, here is property income tax, and I pay property income, let me pay income tax. If I sell my laptop as a person individually, I have to come back and declare property income and then pay the tax. Now, this is not very clear if that was the intention. All they needed is, or what they intended is to say, if you sell your car as an individual, if you sell your land as an individual, come back and account for the taxes, as opposed to the previous law, which was attacking only the companies, partnerships, and everyone who was running a business. So we believe the law is not very clear on that, and we believe the parliament is going to come back maybe in the next meetings. In the next sittings, they may have to fix and create a control around this so that the drafting and the policy is rectified. So moving on to the next one. They've also provided for a bit of an exemption for 3 categories of people. The first one is the hotel and tour sector. So everyone that is going to be developing property in the tour sector, anyone putting up a facility or a hotel is going to benefit from this exemption. This is typical from the exemptions that the government has provided before that are sector driven. We've had one that has been inclined to we've had one that was inclined to the hospitals. We've had one for manufacturers. So we now have one for hotels. What they're trying to say, if anyone and is a non-resident or foreigner, in this case, is willing to invest 10 million, they are going to waive the income that they earn from that project. If it's a resident person, a citizen, in this case, you have to invest 5 million. For you to be eligible for this kind of waiver or the exemption, you need to be able to demonstrate that you've used 70% of your resources locally and the materials. Employees, 70% should be citizens, i.e., on the worksheet that you're working with, on the payroll that and the pay returns that you file, all this should be citizens of Uganda. And 70% of that's accounting for 70% of your total wage bill. So do not have one Ugandan and then you have a bunch of you have 10 Ugandans, one non-resident or one foreigner, and then the foreigner earns more than the Ugandans in total. So they're trying to break the ratio to make sure that if you're paying people, 70% should be Ugandans, and also their earnings should be forming 70% of the total wage bill. So that actually they encourage more Ugandans getting business, more Ugandans participating. So that is one. Then two, they've also tried to clarify on the infrastructure bonds that they've tried to explain what the infrastructure bond is. So previously there was a definition but was not very conclusive. So they are trying to define it to say that anyone that is, if you have the infrastructure bonds, so they're now defining those to be bonds, notes, or similar securities used to raise funds or public infrastructure and social services with a maturity of at least 10 years. So previously, this was not describing the details of the maturity to include the 10 years. So now that is being clarified. And so for anyone that is dealing with those, you may want to watch out for that clarity in the definition. Now, this one is one of the most interesting items for anyone who is running a company with other members in the group, with other related parties, and you've had to borrow money. And from the monies you've borrowed, you've also had to pay some interest. So they've come back to adjust the laws to say, and this is really to kind of implement some recommendations that were passed on from the OECD previously, and also for them to make sure they do not frustrate some of the key players in the sector. So MFIs, that's the microfinance institutions, and the tier 4 institutions were not previously categorically included to exempt their interest claim. So previously, the interest expense that they were claiming was also being considered as if it was one of any other companies, and then they were also making it impossible for them to claim back as much as they can when it comes to the debt, or that is for the debt. Every time they had a bad debt, they were not allowed to claim everything. Now, with this new law, they're going to propose that they can claim back almost everything as long as they met the key conditions. This is similar to, let's say, a normal business that is operating. If you're operating and let's say you have bad debt, now the bad debt that you're allowed to claim, you have to meet a certain criteria. Now, for financial institutions, they have a particular approach they have to follow, and this is linked also to the Finance Act. Now, they are now including the microfinance, the tier 4, and then they're also including they are now including these entities to be the ones that can also benefit from that. The next one is on the interest capping. So most companies that have international affiliations, or they are a member of a group, they may have noticed that in the last few years, every tax computations that you receive, you have to review, you have to approve. There's always an element of tax EBITDA. This is strictly different from the typical EBITDA, but the concept is really the same because of it's slightly different because of how Uganda adopted it. So the typical accounting word would have meant the earnings before the interest, tax, depreciation, and amortization, except for Ugandan purposes or for the tax law purposes. What was adopted is the tax earnings means chargeable income because of the way it's defined in the Act. And then you make the adjustments for the interest, for the taxes, depreciation, then amortization. Now, the definitions under this category for people eligible to make these adjustments has been revised after the Techno 3 versus URA case, to say that if someone is dealing with parties or related parties that are dormant, then that person is not going to be considered to be having a group. However, for that to be called for also one to be considered to have a group, that definition has been revised to say that it should be for persons, and that's non-individuals, with more than 51% common underlying ownership. Sorry, I think we have someone talking in the background. Evelyn, you'll help us see if you can help with the muting of the attendees. Thank you. So for the definition is now revised to say a group is going to be is now a member of is now going to be a person or a member, or who is a person. A group is going to define a member or a person with more than 51% of underlying ownership, excluding dormant members. Now, this I'm adjusting the definition, not to read verbatim the one that they've recommended, because we believe there's a bit of a challenge in terms of how they've drafted it. They've included the word group in the definition of the word group to exclude dormant members. So we believe the way they've drafted the word, the definition, is going to cause problems, because for you to be a member, you need to be part of a group, and for you to be dormant, you're part of the group, which does not make sense at the moment. So what we are recommending, of course, is if the parliament does not come back to rectify this, that is something that people are going to struggle with. Then also a dormant company has been described to be an individual entity that is not doing business and has no accounting transactions in a year. So accounting transactions have not been explicitly defined for tax purposes, meaning bank charges could count for accounting transactions if at all that nothing has been done, because someone will have to do financials if they have these transactions on their bank. If you paid, let's say, a company secretary for a dormant company to maintain it, is that going to count for the accounting transactions in a year? That's very possible. So we believe there are some loopholes in this drafting that needs to be rectified. So it would be decent maybe for the parliament to come back and say the dormant companies, let's define them, but also give clarity on what accounting transactions are. Maybe set a threshold of the transactions to make sure that it's simple. For a group of companies, underlying ownership interest is not a technical word that we've seen before, that they've introduced it, which is going to be challenging. They've added the word underlying ownership with the word interest. For the first time, we now need to be able to clarify and say if it were intentional or if it's a mistake, because underlying ownership and interest sort of mean the same thing. Now, that is also another challenge that we now need to see if can be rectified. But again, that's going to be the parliament to assist with that. If they don't, every taxpayer will have to make sure they seek a ruling or they work with advisors to make sure they get the favorable treatment. The other item that has been revised is farm works, which were currently included in the fourth category, and now being revised, and they're repealing that class. So that class is now being repealed so that you do not have to have the farm items in being classified as class 4 items. So that is one change that is also going to be coming up. So people involved in farming, they will have to come through and double check and see how their wear and tear schedule looks like, and then they can be able to confirm if they are going to change the classes. And there's always a bit of science, but you can always talk to your advisor. Changing from one class to another usually requires that you close off one with a balance, make an adjustment, carry it to the next one as an addition so that it does not affect you. So usually it's a simple process to take on. Now, another change that is happening that may be considered as controversial is that three years ago, the government proposed that and implemented that everyone who carries forward losses for 7 years, after the 7th year, you will stop carrying forward that loss. You'll be required to have that loss going forward. So you're supposed to be carrying forward 50% of the loss that you started off with. So hypothetically, if I started off with 50 million as my loss, next year, after the 7th year, I'm going to have to consider only 25. The next one, I'll have to consider 12.5. Now, that has been running for 3 years now. Now, the government has also is now proposing to amend the law to say that if you're carrying forward the loss after 7 years, instead of just carrying forward the loss, they're now saying they would prefer that a person pays tax of 0.5% on the gross income of the taxpayer. That means if I made turnover of 20 billion, but I've been carrying over a loss over the last few years, and I still have a loss of, let's say, 4 billion. So whilst I'm making the loss, they're now also saying pay taxes on the amount that you've earned as gross turnover. So you'd have to come back to your turnover and say of the 20 billion, 0.05%, that is 0.5%, or half of 1% should be paid regardless of the loss you're making, but the loss should still be halved. So this does not make sense from that perspective, that is going to discourage people that are making losses from the normal course of business, because whilst no one sets out to make losses, losses are natural occurrences in business. Sometimes the circumstances that are triggering the loss can be accounted for, and you can tell why you have to make this loss. So that is one. Two, the timing of this law is that they are setting a 7-year timeline, but they're not clarifying when the 7-year timeline begins. Is the 7-year timeline beginning today, or is this law one of the only ones in this year that is going to apply retrospective, that the 7-year being referred to is 7 years beginning with 3 years ago? Now, the law is not mentioning that. It means technically, when you're applying the law, you're going for you to implement it. Now, since this is not provided as clarity, it means there's going to be an exposure. Taxpayers may want to work out the easiest approach to make sure they beat this. So that is something that we believe every taxpayer should look out for, especially the ones that are making losses. And if you're making a loss, please track your losses. Do not wait for the URA to remind you when the loss came up and when it should stop. Then the other change that we're looking at that is going to be maybe not very interesting is previously we had people who are benefiting from debentures. People are able to borrow funds from out of the country. They were able to get them at reduced rates, and also the debentures were usually almost tax-free for some taxpayers, if they met the conditions. Now, the government is now recommending some changes that are going to move that category from 15% from previously, which was 0, to now almost qualify for almost 15% to qualify as any other interest, unless if you can confirm to particular conditions. Now, the movement is supposed to move people to consider borrowing money locally, because we have borrowers who are here locally. It's also supposed to remove the additional benefit people are getting without having to participate locally or even bringing back money. So there's a bit of revenue being lost on that interest that was not being paid up for in terms of withholding tax. So the government is trying to collect on that. This is now something that will be much better for the government and not good for the taxpayers at all. Because if you have to pay taxes on those debentures, which you previously did not have to account for, that's going to take a toll on the borrowing. So some businesses are going to be frustrated. And we expect there may have to be a pushback. Businesses may have to push back on this so that the government can reconsider the treatment. So that's on that one. Now, the next adjustment that we are seeing the government propose is on the digital services tax. Now, recall I made in the beginning where I discussed that the definition of royalty has been revised to include software. Now, royalties were previously treated as digital services items. Now they're taking royalties out of digital services and they're leaving them to be taxed under Section 82, so that if you have a royalty, you pay no more taxes. That is 15%. So that means if I'm working with, let's say, Forvis Mazars in France and I'm paying the royalties, I would have to go with 15%. Previously, we could have had an arrangement where Forvis Mazars registers for digital services tax in Uganda and deducts 5% or charges 5% and pays to the government of Uganda. So they've changed the dynamics. Now, they've removed it, but also removed softwares as well from digital services. Because in royalties, in the definition of royalties, they've included the word software. So if you have softwares that you're dealing with, you need to pay attention to how this law is going to come into play. And it may affect you, because where you've been charged 5% or 5% previously, now potentially you may have to pay 15%. And that's something that is going to be big. Now, the discussion that we're going to be seeing that is coming through is that the definition of software and maybe any typical digital service like cloud service sometimes are the same. Now, if the government does not come back to explain why these are different, it's going to be very difficult for people to side with the most expensive one as opposed to the cheaper one. So what we recommend if for taxpayers or clients, please consider, if the law passes the way it has been done, you may always want to reach out for a private ruling before you proceed with the payments, so that you avoid being on the wrong side of the law. It's usually much better to have this streamlined before you transact, as opposed to leaving it out in the open. Almost everyone has a software, and the simplest, which is, for example, the Microsoft services that most clients use, most taxpayers use, we need clarification. Is it a digital service in form of a cloud service because it uses cloud computing, or is it a software, or can they list the ones that are obvious and give us a criteria we should follow to determine what is a service which is the software that we should consider the service as opposed to the other. So another adjustment that has been made, the government is, of course, as usual, they are trying to improve on the tightening on the revenue loss and the BEPS action plans. So they've made an adjustment where they're saying related party transactions need to be maybe more streamlined now. Previously, there was no particular system for codifying these transactions, and there was no particular law that was there in place to say this is the law for transfer pricing for arm's length transactions. We don't really have a tax law separate, but they're now creating a category for it, meaning what we expect with a few more years, we're going to be seeing slightly more work being done by the revenue authority, by the government and policymakers to increase the impact or the discussions or the discourse on international tax, and there will be a particular law that is going to be affected. So we then will expect if there are changes, there are parts that are going to be affected, and we should be able to see why these are going to be problematic. So in the recent few months, we've seen tax cases that have been taken to court, and others even have been moved past TAT, where the decisions are not favorable and they are linked to international taxes. So this section is going to be interesting for everyone that has suffered before and also that plans to manage their taxes. Please pay attention to this. Then the other adjustment that is being made, they are introducing monthly rental income tax returns. Now, landlords or landladies have been dealing with their income tax on rentals slightly differently. They've been working in maybe at the end of the month, a year, and then they pay whichever amount they've had. But now the government is asking, declare this monthly. When you declare this information monthly and pay the taxes, you most likely are going to commit yourself to a certain number, which is different from what was being done. So landlords are going to have to share returns on the portal. The return templates have not been shared yet for people to preempt and see what they have to work with. It's not also been made mandatory for now. They're saying you may file. They've used the wording, the policy and the drafting is not very, very, very honest for people who want to see something very intentional and deliberate. It's saying that an individual may be required to file. Whilst that is may be required to file, it means it's not mandatory, but also if it happens, when do you file it? Is it every 15th day after the end of the month? Is it on the first day of the month? That has also not been clarified. But when this happens, it means the compliance around rental business is going to be escalated, and most likely the reviews for rental income are also going to shoot up. Why? Every single month you miss filing and paying the tax, they may come back to you and knock on the door, the way we see it happen on withholding tax, VAT, and pay as you earn. Every time you miss filing a return, someone is willing to come even to pay you a visit to see why you've not done the filing. An agency notice can be flagged onto your account if at all you've not declared money, because they have an expectation. They have details of tenants now. You may have to put details of the tenants in the returns. We don't know what they're going to ask for, but it's possible. You may have to put names, telephone numbers of the tenants. So when you shift or you say you've shifted, the revenue authority can easily call up the person and ask, where have you shifted to or what has happened? Okay, we don't know, and this is speculative, but we believe there are very many things that can happen with the new change, and this is going to improve compliance when it comes to the URA side, but it's going to become very expensive for landlords, especially the ones that own maybe small properties or the ones that have not been looking at this before as something very serious. So we advise everyone who has rental income for properties, look into this. It's not very clear. The law is not designed well, but in case it's passed the way it is, please talk to an advisor. Make sure you seek clarity and you comply so that you do not miss any deadline. The deadline is not available as of now, but at that point, at point X, I believe it may be communicated. So also, we had discussed earlier in the definition from the definitions that they've included non-business assets. Now, previously, we did not have non-business assets being challenged. We only had business assets being exposed to withholding tax. Now, explicitly, they've come back and said anyone that buys a non-business asset, you'll be required to account or withhold 6% and account for taxes. So what this means is your typical purchaser is going to be buying, let's say, a car. Now, if a car is not a business asset, you, the person buying, potentially you will be required to withhold 6%, which is something that you'd have said, oh, I wasn't required to do this before. And that's correct. So the law is not very clear on what a non-business asset is. We know what a business asset is, but the opposite of a business asset is not a non-business asset, because the what makes a business asset is the entity that is in business and the function that the asset does. Now, which we don't see being so obvious. So we believe the government may have to come back, the parliament may have to come back, and the policymakers draft this better and clarify what is a non-business asset, or what the criteria we're supposed to use to determine something is non-business or is business. Without it, we're going to struggle. We're going to see a lot of non-compliance. People may sell their phones, caps, pens, and pencils, and they may not account for the 6%, and that may be problematic later. But also, given that these things are not in any platform, they're not in any accounting system at the moment, the personal assets, it may be difficult for people to also adhere to this and comply with it, because if the government did not know that I have a watch, why would I come back and account for selling a watch? What is there to enforce accountability or transparency for the transaction? So we believe some of these changes are very difficult to implement, and clear before. But of course, whenever these things come up, this just affect very many users. The betting companies or gaming companies make a lot of money from residents in Uganda. So we imagine there's going to be a lot of attention, and the media is going to blow out for them to ask for clarity on how this is, why this is happening like this, or is there more clarity that can be provided on what net winnings is or what net stake is. So we believe there's going to be a lot of attention. The other one that has changed is on the withholding tax, is on the telecommunications. They've expanded their scope by being very ambiguous. So in sense, what they've done, they've said for telecommunication services, providers, they must withhold for 10% on the commission for the following services: telecommunication, retail services, mobile network services, and then provision of mobile money services. Now, this looks very nice and simple until you realize you do not have a definition of what telecommunication retail services is. We know mobile network services broadly. We also know mobile money services broadly, but what is included in telecommunication retail services? So we believe the scope has to be increased. Increase the definition section to provide clarity on what telecommunication service retail services is, mobile network services, so that we know everyone who will be covered under this, and also at what point this commission applies, if at all there is a commission on telecommunication retail services. Now, that is broadly the challenge that we think we may find on that one. The other one that is a bit controversial is on withholding tax on public entertainers. So whilst this is simple in terms of the reading, it's very ambiguous that a person who pays a public entertainer shall withhold 6%. Now, if a relative of a public entertainer gives them money, potentially they are required also withhold 6% from the current drafting. From the current drafting, if a public entertainer decides tomorrow to drive an Uber for additional income, you're required to withhold 6%, because the law is not clear that what is it you're paying for to the public entertainer that will require you to withhold. So this part of the law lacks a nexus to what you're paying for and what you'll actually who you're paying. So we know we're paying a public entertainer. We don't know what we are paying for. So any payment you make, withhold 6%. So technically, by By way of example, a company like Swang's Avenue can decide whilst paying its artists, let's say Vinca, they could decide to deduct withholding tax at 6% as opposed to deducting pay as you earn, because now the law is saying if you're paying a public entertainer, apply this law. Now, we believe this is, of course, ambiguous and clarity needs to be made so that people do not confuse public entertainer with maybe any other type of entertainer, so that people do not confuse this payment with the obligations of pay as you earn. Does this suspend the application of withholding tax that was being paid in form of pay as you earn for the public entertainers? This law does not clarify that, and we believe it should be clarified so that it makes life better. Now, public entertainers, this is now in the section that caters for the residents. We may need to see something similar also to clarify who a public entertainer is on the non-resident, so that we know for avoidance of doubt, no one is going to miss applying this law the right way. Then on the other changes, we have on the foreign sources of income. This is now done from the discussion we've had where they codified the anti-avoidance rules. They've also now come back to introduce the compliance for individuals with non-resident with foreign sources of income. For example, for every resident person in Uganda, for example, myself, if I had, let's say, money in the UK, in Netherlands, in France that was earning, they're now saying also that should be taxed at the same rate of the amounts that have been paid and earned in Uganda. So in that case, if I earn 10 million in Netherlands, they're saying the 10 million that I earned in Netherlands shall be taxed at 30%. Sorry, for an individual, let's say 30% or 40%. Now, if I earn the 10 million and Netherlands removes 20%, Uganda is going to still have the right to tax the excess amount of tax that was not applied. So 20%, Uganda will say, if you're taxed at 40%, they'll say 40% minus the 20% you've paid, and the excess 20 will end up being taxable in Uganda. So we believe the law is introducing this is clarifying, because this was already sort of in the law, but they're clarifying so that they avoid doubt that people do not believe they have an exception of the taxes that they have to deal with. So coming to the end of the presentation, just with a few more slides, there was a change in the pay bands. So the newspaper articles may end up showing us that taxes have been reduced, everyone should celebrate. So from a technical perspective, it's true, the rates have been reduced. However, the actual reduction that we've seen is just 13,000 averagely. It's about 13,000 for every band. So anyone that has been computing pay as you earn, everyone is going to pay less by 13,000. However, from a technical drafting, they've introduced 5 bands and they've introduced 5 ways of coming up with these taxes, which means potentially some of the bands, if you used a strict interpretation of the law, the wording is going to be misleading and may cause people to apply the laws differently. They've introduced a category which introduces applying of 30% and 10% of the excess amount of the 10 million, which means people have to pay the 10 million separately, the tax on 10 million separately, and the excess of that computed also separately, which may be confusing and is not clarified, as opposed to how the previous law was drafted, which had all those in one category. So we believe the government may have to come back, make a few adjustments, and improve on this band so that they avoid confusion. But in overall, we can confirm, if the law is passed the way it is, if you've been paying taxes, there's the 13,000 that you're going to take back home that will come from this. So 13,000 is very small for every individual, but 13,000 is very big for the government in terms of all taxpayers. So if 13,000 is lost per person every year for the next, let's say, 5 years, the government gets to lose a significant chunk. Individuals may not lose as much, may not benefit as much in the 5 years, but it's also a good change. It's a positive. So that's the end for my segment. I'm going to hand over to my colleague, Nal Wangarita, who's going to take you through the next few amendments that were proposed. Feel free to plug any issues that have come from the segments we've discussed. If you want any question to be addressed, if you want any clarity, I'll be addressing that in a moment. Thank you very much. And let me introduce my colleague who will take over.
Okay. Major, thank you so much for that. I would encourage everybody that has any questions to sort of hold on to those questions. I will ask them at the end. The beauty is that every segment has a particular bill it is discussing. We've just finished income tax. So anything on income tax, the questions you have, please hold on to those. We'll ask them at the end of the session, so that what the idea is that we go through all the bills, and at the end we can be able to ask those questions. So thank you very much. For the person for VAT, please go ahead.
Good morning, everyone. Thank you, Major, for that presentation. My name is Rita, as I've been introduced. So I'll be taking you through the VAT amendments. So on VAT, the first amendment relates to the VAT withholding tax. This was introduced around 2018, July 2018, but it faced a lot of backlash from taxpayers. It had some complications on how people were supposed to account for the VAT. So it was later revoked. And then it was restated in January 2020 through a public notice. The URA issued a list of designated taxpayers that are required to withhold from payments for VAT. So how it operates is that if you charge a designated agent VAT on your sale of, say, 1 million, the designated agent is supposed to withhold 6% of that VAT amount and remit it to the URA. It is similar to withholding tax, just that withholding tax is on the gross payment, but this withholding, the VAT withholding, is on the actual VAT amount. So right now, the proposed amendment is that it should not apply to persons who issue IFRS invoices. So if you issue a designated agent for VAT withholding with an IFRS invoice, that person is no longer going to withhold from you the 6%. So this law means it's going to render the VAT withholding exemption. Right now, the exemption is open. It's opened last week on Monday. So the applications are being submitted to the URA. But with this amendment, it means as long as you're compliant with IFRS, you no longer need to apply for a VAT withholding tax exemption. I hope that's clear. So we are moving on. And the next amendment, it's about the VAT registration threshold. So the current VAT registration threshold is 150 million. This was revised in 2015, about 10 years back. So the 250 increases by 100 million. Before 2015, the registration threshold was 50 million. Then they increased it by 100 million to 150. And now the proposal is to revise it upwards to 250 million. Given the current inflation and then the exchange rate, you may find that the shilling, 250 million, encompasses so many taxpayers, which means URA has to follow up with each and every one to ensure that they're compliant, they're filing their monthly returns, they're generating IFRS, they're making the payments. So it makes the URA inefficient because they have to deploy several employees to follow up with those small taxpayers. So when the threshold is revised, it means URA has enough time to concentrate on other areas where more taxes can be identified and retrieved. So this means if the registration threshold is revised upwards, some small businesses may opt to deregister the ones which were already registered. The voluntary registration option is still available. If you do not meet the threshold, but you wish to register, you can still register. Those who feel like they have been under a burden complying with the VAT monthly returns, they can deregister, they can opt to deregister for VAT, they deactivate that tax head. Because government was also looking at the cost. Some of them have to hire accountants, maybe for this. It will be bad for us, that will lose revenue, but it will be good for the taxpayer. On the other hand, they get to save the monthly fees they are paying to the accountants. But this does not take away the requirement for IFRS. If you may recall, in July 2025, the URA issued a public notice whereby they designated extra sectors to issue IFRS. So IFRS is the electronic invoices or electronic receipts. The people who issue electronic receipts are the ones who are not VAT registered. Then the electronic invoices are issued by only persons who are VAT registered. So if you're in the designated sectors such as entertainment, accommodation, real estate, professional services, sewerage, garbage cleaning, and the like, you're still required to comply with IFRS requirements, whether you're VAT registered or not. The next amendment is on VAT deferment, that is the mining inputs. So before, right now, currently in the law, you can opt if you import plant and machinery above $3,000, you can request URA, you apply to defer the date of payment of that VAT, the VAT if it's above $3,000. So this is being now extended to mining inputs. From some people maybe who are in the sectors will tell us that this is a capital intensive sector. It needs a lot of investment. So this will be a relief to them with this extension, that they can also benefit from the VAT deferment. So we are moving on to the next amendment under VAT. This is in regards to softwares. Sorry, before softwares, we're going to talk about a similar amendment that Major presented on. It's on hotel or tourism facilities. So it's similar to income tax. They are giving a person, a developer of a hotel where the investment is $10 million for foreigners. And then for citizens include East Africans. It extends to citizens of the East African region, not only Ugandans. So if you're a citizen and you invest $5 million USD, and then you incur input tax, someone charges you for civil works, feasibility studies, design, construction services, and then locally produced materials, and those inputs or the VAT you pay, you've incurred it in the last 2 years before you commission the hotel, you're allowed to claim that input tax. So imagine if you're investing in a hotel, you're spending 10 million USD or 5 million. You can imagine how much VAT you've incurred on those projects. So the current law is, upon registration for VAT, you can only claim input tax for 6 months back. Input tax is the VAT you incur on purchases. So for you to determine how much tax you have to pay, you get the VAT on your sales, less the VAT you've incurred on purchases, and then you derive or determine the tax payable, the VAT payable for a particular month. So with this input tax of 2 years ago, it means the investors are now benefiting. They have put in a lot to put up those structures. So this is government giving them a relief that thank you for maybe developing Uganda. The soccer lovers are aware AFCON is coming next year, and the committee for AFCON is visiting Uganda to verify whether the hotels are up to standard, where the players will be staying, where different tourists or supporters from different countries will be staying. They're checking the stadiums, but now particularly the hotels. So someone who is out there constructing that hotel to meet the AFCON target or to host some of the spectators, they will be able to benefit from this as long as the hotel is commissioned. So the commissioning, maybe the definition of commissioning may need to be defined, but we may use the dictionary meaning to mean when it's complete a certain part, but it should be the whole hotel should be operational and receiving guests. So you can claim the VAT for the last 2 years. The current law, you can only claim for 6 months back upon getting registered. And then, except for people in the construction sector who are allowed to claim a maximum of 1 year, 12 months. So this is a good thing. We believe this amendment should be passed into law. So the next amendment is on the non-creditable input tax on imported software. So there's some ambiguity whether a software is a good or a service. So the interpretation is that a software is a service. It's not a good. So people have been bringing in softwares on CDs, flash drives, hard drives. So when you reach customs, you only declare the drive. And then URA would classify the drive according to the HSC codes under customs. So they will only subject the drive to the customs duties on drives, but not knowing the main content that more than the cost of the drive itself. So URA has been losing out on that tax. And now they are clarifying that because a software is a service and you brought it from outside Uganda, just like any other service, once it's brought inside Uganda from abroad, it is subject to reverse charge VAT. Now that reverse charge VAT is not claimable. You cannot claim it as input tax except persons who are engaged in petroleum and mining activities and then business process outsourcing. The rest of us, other service providers, if you're in another sector minus those three, you're supposed to pay reverse charge VAT. Remember, the aim here is to promote BUBU. Buy Uganda, build Uganda. So we have very many software students, Makerere. We have had recent graduations this year in January, February. Different universities are rolling out graduates. So some of those students are brilliant. They can develop softwares here. So URA stroke government would want you to support those Ugandans and purchase from them those softwares so you don't incur that reverse charge VAT. Remember, even for the person who's developing the software, they are employing Ugandans if they're doing it here locally. So it increases on the market, employment opportunities for the Ugandans. So that's the aim. There's clarity. They are providing clarity on the softwares that they are separate from the disk. If you import the software, you pay the tax on the exceeds 50,000. So the current law is if there is a decline, a reduction in the VAT refund amount that you've applied for in excess of 50,000, the URA will not pay you interest on the difference. But now the amendment has come in to clarify or to help taxpayers. They are increasing the value. This has been increased to, sorry, there's an error here, but it should be 1.5% of the application amount. So they paid your money to government, they have used it for maybe other things, probably spent it on roads, the good roads that we have. But then they are saying we won't pay you interest because there is a difference. So they have now increased, for purposes of inflation, 50,000 is a very small amount. And to take you back, this provision has not been amended since when the VAT Act was established back in 1996. So imagine from 1996, 50,000 was a lot of money in the 90s, in the early 2000s, but right now, people will tell you maybe their children, 50,000, when you give someone, a student, 50,000 as pocket money, it's nothing, may not take them through a week or so. So they're increasing the rate, the amount to 1.5. Then the next amendment relates to VAT refunds by persons who are not VAT registered. So the persons who are not VAT registered, if that's someone whose sales do not exceed currently 150 million at the start, the second amendment I talked about was the proposal to increase the VAT registration threshold from 150 million to 250. So if you're below the current threshold of 150 million, you're not supposed to be VAT registered unless you voluntarily do so. So there is this amendment that the URA introduced back then in 2020 to encourage people to apply for refunds. So the refunds has been, if you buy things worth 5 million and you incur VAT, but you're not a VAT registered person, you could apply to URA to give you a refund of the VAT you've incurred, as long as that expense or expenditure has been incurred within 30 days or a period of 1 month. Right now, this is being revised from 5 million to 2 million. Maybe a few people can afford to spend 5 million in a month on just purchases which have VAT. So they're reducing it to 2 million to increase the number of people who can access the refund. But it also, in essence, at the back of the government's mind is to encourage IFRIS. Remember, with IFRIS, the URA has visibility of people's transactions. So on the other hand, there's a buyer who wants to benefit from the refund, and then there's a seller who wants to also make sales or increase by getting customers who want to deal with VAT registered people. People will be motivated to go and support or buy from persons who are registered for VAT or who have IFRIS, who issue IFRIS, so that they can also get the refunds. But bear in mind that indirectly, the URA will also be looking at the person who is claiming or seeking the refund, because you cannot be affording to buy things of 2 million in a month, and then you claim that maybe you earn a very low salary, or okay, you have little income, like you do not have, when URA looks for you, maybe looks up your income tax declarations you've declared, let's say in a whole year you've declared income of only 3 million, but you've applied for refunds that you've bought things above 2 million, like 3 times in a year. So there will be that contradiction. So you should be aware of that as you apply for the refund as a non-VAT registered person, your declaration should be able to match what URA was looking at, lifestyle. They wanted to do lifestyle audits. So if you purchase things of 2 million and you want a refund, but then your income declarations don't match that 2 million that you're already spending on a regular, you should be aware of that. So the next tax head that I wish to discuss is the stamp duty. So the stamp duty amendments, there are few, there are not so many. So this one, the proposal is to require financial services or persons who are engaged in provision of financial services to file monthly stamp duty returns. The current law is that only persons who offer insurance business are the ones who are required to file monthly stamp duty returns. So the government is extending the sectors to include financial service sector, the financial sector. So this is not an extra charge, it's not an extra tax, it's just a requirement, like a compliance requirement just to file a return. But it's only being restricted to now financial services as well as insurance. So these two sectors have voluminous or humongous stampable transactions. So you find that maybe if you apply for a loan from the bank, you have to pay stamp duty. If you need maybe different services from the bank, they charge you some stamp duty indirectly. So with this requirement to file the returns, the URA, government's aim is that the URA will have visibility of the bank's transactions, because currently the bank just makes a payment, but the URA doesn't know how much did they actually, how many stampable documents did they actually have. So with now the requirement to file the returns, they will be able to declare the different transactions. Then the URA can go back and track those transactions to, let's say, the books of the bank, the MFI, everyone who considers themselves a financial institution as per the Bank of Uganda, the Act. Or if you qualify as one, you should consider this. So you should start preparing to file those monthly returns. They are already there since the insurance companies are using them. It's not a different return that you need to wait for. Just familiarize yourself with what's needed, which areas you need to fill, and maybe request the compliance department of your entity to start preparing or compiling information that is suitable to complete the return. So there is a penalty, of course, or non-compliance calls for penalties. So if you don't file that return in time, you face a 2% interest charge on the tax payable. So this is similar to other tax heads like income tax, but given that banks are already under a lot of they report to several regulators, this is going to be an extra requirement. All financial institutions, not only banks, they are required to report to several regulators, and they usually face these penalties. I'm certain that this is something they'll be able to manage. It's not a big deal, but you should get ready. So if you recall, around 2024 and 2025, early 2025, URA was doing several audits on stamp duty until last year or this financial year on agreements, until this financial year when that provision in the law was repealed. So the Stamp Duty Act, the bill also proposes to amend it to provide for a requirement to retain or keep documents relating to stampable information for a minimum of 5 years. The mode has not been provided, whether this should be hard copies or soft copies, but you can retain in whichever format you wish, because paper has also fed. So you may retain the documents in a suitable format. This is also in line with the Tax Procedures Code Act, Section 15 on records and bookkeeping. So it's a similar requirement of 5 years, but don't only keep books for 5 years. We have seen URA auditing taxpayers beyond 5 years. There's that law provision which the URA nowadays relies on, that if they believe you've been reckless or you're intentionally trying to avoid tax, it's hard to prove whether it was the taxpayer's intention to evade or avoid tax. So you just keep the documents for as long as you can, but 5 years is the minimum. So this is the second last amendment under stamp duty. the transfer of land, the rate has been doubled. It has been, the proposal is to double it. Sorry, it hasn't yet been doubled. It's until the president assents to the laws that they will be passed. But for now, this is what government is proposing. So the current rate is 1.5%. So they want to double it to 3%. I believe this is high. Despite the bit being on the value of the land, if the land is worth 10 million, you'll be required to pay 3% of the 10 million, besides the other costs to make the sale that you've incurred, such as brokerage fees. Then the last amendment, the last proposal on stamp duty is on motor vehicles, motorcycles, tricycles, quadricycles. This is the registration amount. So if you register or transfer a motor vehicle or intend to after 1st July, okay, from 1st July going forward, or after 30th June 2026, for motorcycles, quadricycles, tricycles, the rate will be 50,000 Uganda shillings per motorcycle. For cars, it's going to be 200,000 Uganda shillings. So this increases the costs for the car transfers, for the different vehicle transfers. So right now it's 0. Then the normal transfer fees have been for motorcycle, currently it's 74,000. Then for a vehicle, it's 84,000. So in addition to your normal transfer fees, you have to add either 200,000 or 50,000 to just transfer a car or tricycle, quadricycle, motorcycle. So, but this law right now, if it is assented to, it won't affect cars or tricycles that are already on the way or being cleared before 1st July. So you should prepare, or maybe if you intend to sell or transfer, if you've never transferred the car into your names, this is the time you have between April and June to complete this. So we have seen a lot of backlash from Kasita this week. They have been in the papers. They're saying this is too high. Taxis, border cyclists, they are low-income earners. But government, on the other hand, is also saying, but such people, we won't be able to get them. Once the motorcycle is on the road, you'll never receive income tax from that border cyclist ever again, yet probably they are earning money from Safe Border or Uber or Faris. So there's still that discussion. We don't know if the rate will be revised or it will be maybe totally abandoned, this proposal being totally abandoned, or maybe the amounts lowered. Then the next act, the bill that we are looking at is the External Trade Act. So this one is, as the word says, external. It's about Uganda transacting with its neighbors or other countries abroad. So it relates to importations. So the first one is the infrastructure levy and import declaration fee that were introduced in July 2025. So this financial year, the current financial year, that's when they were introduced. Infrastructure levy was introduced at 1.5%, and then the import declaration at 1%. So these were on different items. There were certain exemptions already provided for, but then Parliament went back and sat down to review this provision, and they looked at these sectors or some of these items or goods that had been excluded from the exemption. So they include vaccines, medicines, pesticides, insecticides, and the like. The list is there. So passed because accessing medical or treatment and then food, it's a human right and one of the basic needs of human beings. So if vaccines or pesticides are being subjected to high taxes, it means food, the cost of food, the cost of access to medical care will also go up. We need a healthy population to carry out work. And then, of course, in turn, it boosts the economy because you have a healthy workforce. It means people will be working more, taking on maybe jobs, and then the government indirectly benefits because it will be receiving taxes. On the other hand, agriculture is the backbone of Uganda. That's what it says. There are several members of parliament. There are several, even the president himself has claimed that he's a farmer. So there's a big percentage of the population that is engaged in agriculture. So this will also boost the agriculture industry, but also do what? Cut on the cost of food and then reduce the cost of living for people generally. Then the last amendment on the External Trade Act Amendment Bill, this one is on the environmental levy. So they are introducing a 30% environmental levy on the importation of used or worn clothes that people usually call mivumba, ndivota, or mitumba for those who speak Swahili. So this amendment is around also, it extends to, sorry, I think somebody's talking. So this
Sorry, I've
amendment,
muted them. I've muted them.
okay, it's okay. So this amendment is about, as the law says, it's environmental levy. So it's about protection of the environment. Because the one clothes, once they are dumped, when someone is done maybe wearing it, it leads to landfills, and then we are all seeing what's happening right now. We can no longer predict whether it's the rainy season or whether it's the dry season. It either shines in the months where it used to be the wet season. It rains anytime. So this is to do with protecting the environment. Though we have also seen, as I mentioned, under the motor vehicle registration fees, Kasita has also come out on this. They are saying that this is too high. Most people can't afford new clothes, but it also goes back to our dear, we had AGOA, we had NITIL, we still have them. So it's also going back to Bubu, buy Uganda, build Uganda. So Uganda should be able to buy from these factories and support them. The president proudly mentioned and said his shirts are from NITIL, so we should also consider buying from these local industries instead of importing used clothes. So the last amendment that I'll be discussing relates to the Lotteries and Gaming Amendment Bill, a Kapapula. For those of us who are out yesterday watching Madrid, those who are watching Arsenal, I'm sure you can relate, although this amendment doesn't really relate to you, the person who bets or who plays those games of chance. This is now to the person who offers those services, Betway, the likes of Betway. So if the act now, the proposal is to increase the rate of tax from 20% to 30%. So this is on betting. It has been 20% as compared to the one for gaming. Gaming right now is at 30%. So they are ensuring that it's uniform for both. The people who play, who engage, maybe who participate. There's the famous one which is like Aviator, the one which is like, I think it's like a plane. Those are games of chance. Then there's the actual betting, the acapella, where you go and say, I think Madrid will beat will score, let's say 3, and then the other team maybe will lose. So the two are different. There's gaming and betting. So now they're making it uniform. Both of them should pay tax at 30% on the difference between what they received from the different participants, people who placed their bets, and how much they paid out. Thank you. That has been my presentation. You can raise your questions in the comments section if you have any. Those who wish to present, who wish to talk during the Q&A session, you'll be given an opportunity. I'd like to hand over to my colleague, Patricia, to take us through the final parts of the amendments.
All right. Thank you so much, Rita. That has been amazing. So for those of you who also have questions on the VAT amendments and the rest of the amendments that have been presented, please hold on to your questions. We're going to give you a chance. So we would like now to have the next speaker to present on the last part of the amendments.
Okay, thank you so much, Rita, for your presentation. So I'm going to be presenting on the tax procedures, starting with the Tax Procedures Code Act, the amendment bill. So the first amendment which has been proposed by Parliament is to reduce the penalty on tax imposed on tax stamps. So it was previously 50 million, and now they've reduced it to now just 2 million. So the reason I think for doing that was previously we had, of course, like small, medium enterprises. We have small shops that are selling beverages because tax stamps are imposed on beverages, alcoholic drinks, cement, things like that. So you find that manufacturers have maybe sold these things to retailers and then been able to maybe sell them to the final consumers. So if you are or maybe any inspector was maybe coming to your shop and finding that, oh, you have goods that are not stamped, then they would impose a fine of 50 million on you, the retailer, or maybe the person who is consuming the good. So that was a bit unfair because, of course, sometimes it's done in error. It's not the issue of the retailer, because these tax stamps are actually supposed to be gotten by the manufacturers. So there's been some pushback on this, because if you have, let's say, just a carton of, let's say, drinks, or maybe just a box of mineral water that is not stamped, then you'd have to pay 50 million. So this has been reduced to just 2 million, or the value of the goods, whichever is higher. So the next amendment is on the waiver of outstanding tax. So this is a pretty interesting one. We've had amendments, so we've had waivers of tax over the years, especially starting from the period of COVID, when the Parliament wanted to give maybe relief to taxpayers during that period when businesses were not actually functioning. So 2020, 2021, 2022, up to the recent amendment that we have that is actually expiring this year, they've been waiving interest and penalties on tax. But this new amendment is proposing that they're going to waive interest, penalty, and the actual principal tax as at June 2016. So all taxpayers basically who have liabilities that are before that period, all the liabilities are going to be waived. Now, the caveat on this is previously we had, I think, order of payment here. Once you maybe have, let's say, a liability, you clear the tax. That tax, or maybe the parent that you've paid is going to be allocated to your earlier liabilities. So if your business opened up in, let's say 2008, and right now we are in 2024, at the time before the law was amended, they would allocate the parent that you've just paid right now to your 2008 liability. And you find that the current liabilities are now outstanding. So of course that was amended. The parents, we no longer have order payments. The parents clear the liability that you're actually that you're actually trying to settle at that time. So you're going to find that very few taxpayers or very few businesses are actually going to benefit from this waiver. But of course, if you maybe who are non-compliant at that time, this is probably going to be your chance. Maybe you have liabilities, you left the business, you even opened up a new tin. This is sort of going to be the time that you're going to benefit from this. Then also we have, of course, taxpayers falling under the exempt category. Maybe before they were operating as taxable, not as exempt, and they had liabilities that were not cleared. So they've not been paying any tax at all. So these different sectors are also going to benefit from, but most of the businesses that have actually been compliant and paying tax, any liabilities that were before 2016, before the order of payment was removed, have actually been settled. So that's really the caveat on that. The next amendment is on electronic fiscal device. The penalty still has been reduced. That's for e-invoicing or use of e-receipts. The penalty has been reduced from 8 million previously to now 200,000, or 6 million to now 200,000. So both have been reduced. So one is for the issuing a taxpayer that tampers with an electronic fiscal device. So the penalty was 8 million, we now have 200,000. Then the second one is for actually issuing IFRS invoices or e-receipts. Originally, we had that if you maybe transacted and you were supposed to use issue e-invoices or e-receipts for either the VAT registered taxpayers or those taxpayers that have been gazetted. As my previous colleague Rita noted, that the VAT the issuing of IFRS invoices, or the taxpayers that are supposed to use IFRS invoices, has now been increased to not just you being VAT registered, but the different other different sectors. So previously, if you didn't issue an IFRS invoice, the penalty was 6 million, or the tax, whichever is higher. So now they've reduced it to 200. So this majorly came from last year. I am sure you're all aware, last year there were sort of strikes, especially from the people downtown, the Chikubo traders. They were striking that, is this IFRS a new system? Like, is it a new tax? We are already paying income tax. Yet it's not a new tax. It was actually introduced so that URA has visibility of how much people are actually paying on the VAT side and also for income tax purposes. So there were those strikes in that you're imposing the 8 million, not the 6 million, on someone who is sometimes not even making that much money, the small, medium enterprises. And also, I think the lack of awareness, not knowing that IFRS is not an extra tax, it's just a compliance regime. So this reduction of the penalty has been brought in to sort of increase the compliance and also create awareness, and also maybe to increase the tax base. So that's that on the tax procedures code. So next is on excise duty. So there's been a couple of items that have been considered for excise duty, starting with cement, adhesive grout. Now, these are all construction materials, right? I'm sure as long as you're constructing, you'd be aware of course, almost all buildings, cement is like a very crucial thing. Adhesive, grout, the white cement, these are all things that are usually used in construction. So previously we had 500 shillings imposed per 50 kilogram bag. It has now been increased to 1,000. So the effect is that it's going to, of course, trickle down to the construction of a building is going to go higher. Of course, a bag of cement, adhesive, these prices are all going to go high. And the government was looking at, oh, there are so many, I think almost everywhere you pass, you sort of see buildings are being constructed. Farms, like everything is almost like there are almost constructions happening all over. So the government is looking at this is a sector that we are always probably going to benefit of because of where Uganda is going, the development, the infrastructure. So that was the rationale in increasing this, but of course it's going to increase construction. Houses are going to go high in terms of, let's say, rental, because if the cost of constructing the building is high, then that means even what maybe tenants will have to pay at the end of the day is also going to be high. Then the next is on fuel. This one has also, unfortunately, there's a proposal to also increase the excise duty on fuel per liter from 1,550 to 1,750. So right now, I think I think you've all been seeing that prices of fuel are going up. Right now, as I speak, I think petrol is around 5,300. It has been increasing we had, I think, 4,900, then 5,000, then 5,100. And this is not because of the tax. This is because of the current war that is going on in Iran, of course, between the United States, Israel, and Iran. So that's where probably the source of most of this fuel, because us in Uganda, yes, we have the Tilenga project, but we are not yet supplying that fuel to ourselves as Uganda. So most of this is actually being imported. So if the price of fuel is already going up because of the war, and we don't know what's going to happen, we don't know whether the war is going to end, the prices of fuel are going to continue going up because of the scarcity. And then also government is proposing to increase the excise duty, which is to trickle down to the final price, probably 6,000 or 7,000 per liter, which is a bit absurd. So this is, of course, something that I think we are also on our side going to try to push back on in terms of trying to lobby. This is going to be a bit aggressive because fuel sort of feeds into everything. If the fuel prices are high, that means food, transportation, basically the entire economy is depending on fuel. So almost everything is going to go up. Sorry. And then the next is on sugar. So sugar, the excise duty, this one has also been increased from 100 per kilogram to now, 1,400 per liter or 200 per liter. So, of course, they're considering the unprocessed, the cane, the beet, sugar from 100 to 300 per kilogram. So this is a sector that is considered to be booming. So on the government side, they're saying, okay, this taxes on the sugar is also going to be increased. But of course, it's affecting now us, the final consumers, because sugar is used in almost like all households. So you're going to find that also the prices of sugar are going up because of the excise duty. And then also plastics, excise duty has also been increased on plastics. Previously we had 2.5%. This has actually become a bit excessive, from 2.5% to now 25%. Right? So here government was looking at it in a way that they are trying to discourage the use of plastics, that's the sacks, the bags, those buveras, I think what we call buveras, paper bags. These are things that don't actually decompose. So they're looking at it in a way of trying to conserve the environment, discourage the use of buvera. I think if you've noticed, This has sort of been, the use of Bouvet, of course, has been sort of going down in the recent years, going back for, let's say, 2020 and 2021. Right now, people are mostly using paper bags. This is because of government increases the tax so that they discourage the use of the plastic bags. And then the next is on motorcycles. So this has also been increased. We had the current rate for first-time registration as 200,000. We now have it at 500,000, which is, of course, a bit high for these motorcycle or border riders. But again, from one perspective, government is also trying to reduce, because there's so many borders in town. Government is trying to reduce the number of people, or making it difficult to actually own or purchase a motorcycle. That by the time you're actually investing in this, you know that this is how much tax I've paid. So it's sort of going to be probably either the higher income earners or the more responsible people trying to maybe go and get borders or motorcycles. So this is sort of in a way to try and combat or reduce motorcycle or cyclist riders. I think sometime back during this year, they were trying to prohibit the number of the borders and within what areas they can actually enter the boundaries of Kampala or downtown. And then the next is on paint, varnishes. Of course, going back to construction material, we originally looked at cement, whose excise duty was also being increased. Right now, we have the paints are proposing, this one was actually previously not there. We never had excise duty on paints and varnishes. So this one is a completely new one, again, which is going to make the construction costs go high. And hence, of course, maybe rentals, cost of living is also going to go high. And then the next is on cooking fat, which is a household item. We didn't have excise duty on cooking fat. The proposal is now to have 500 per litre. These are goods, of course, the parliament looks at, these are goods that are used in almost each and every single household. So the tax base is actually going to be high because it's sort of treated not like a basic need, but you're going to use cooking fat in trying to cook almost all meals. So this is just to widen the tax base or how much revenue the government can collect. And then the next is on the undenatured spirits. That's the concentrated alcohol before it has actually been, diluted. This is usually imported. So of course, the taxpayers or businesses that are within this category import it and then sort of try to dilute it and use it for the different purposes, sanitizers, and then also alcoholic beverages. So previously we had 1,700 per litre that was imposed on the undenatured spirits. We now have 3,500 per litre, which is of course also going to make the end products of, let's say, the undenatured spirit, the alcoholic drinks, a bit more expensive. So at first this was introduced, the excise duty on the alcohol and the spirits and maybe cigarettes was introduced as in a way of like, this is a sin tax to sort of try and reduce the consumption of, let's say, Ugandans, yeah? But this has been going up over the years. You find that actually the bars or businesses that mainly deal in that sector or that area, their sales are actually high. So now this has no longer now become a way of like, okay, we are trying to reduce alcohol consumption, but this is actually a bigger or wider tax base from the parliament's perspective. Then the next amendment is going to be on the Road Traffic and Road Safety Act Amendment Bill. So we have mainly two on this. The first one being the vehicle age limit has been reduced from 15 years to 13 years, right? So previously we had importation of cars that was old as 15 years from the date of manufacture, but right now it has been reduced to 15 years. Of course, the government or parliament is sort of looking at it in a way that they're trying to reduce or conserve the environment, sustainability. You know, the older the car, the more issues it's going to have, the more fumes it's going to release, and it's also like a danger to the environment. So they are reducing the number of years that of a vehicle that can be imported into Uganda from the date of manufacture. So of course, this doesn't affect cars that are already in transit. If you're already, let's say, sent for the car, it's maybe going to reach 6 or 7 months from now. This amendment or this bill, if passed, will be effective 1st of July. So even if that car reaches after that time period, this particular amendment bill is not going to affect it. So this will be on importation of cars that are after 1st of July 2026. And then the second is still on environmental levy. So again, the rates have been increased. So of course, now that they reduced the years, the older the car, the more environmental levy that you have to pay. I think you've noticed it as long as you've imported a car. If you import a car that is 20 years old, you'll find that you'll have to pay a higher environmental levy tax compared to if you're importing a car that is, let's say, date of manufacture 2025. So depending on how old the car is, that's how much tax you're going to pay in terms of environmental levy. So the proposed amendments are for depending on the year of manufacture, 9 years old, that's 20%, 10 years old, 30%, 11 years old, 40%. So of course, as you see, the older the car, the higher the environmental levy. So this is also, again, still increasing how much vehicles or importation of vehicles and the final cost of a vehicle incurs, because if we are discouraged from importing older cars, then we are going to have to import newer cars, which newer cars are definitely more expensive than the older cars. So if you're importing a newer car, the CF value is of course also going to be high. That means the rest of the other taxes that you have to pay, the VAT and any other taxes that you have to pay on the car are actually going to be high, even though the environmental levy is low. So this is sort of like a double-edged sword. You sort of maybe try to reduce taxes this side on the environmental levy, but then also the CF value is going higher because of how new the motor vehicle is. So this is sort of amendment that has been proposed. Thank you very much for listening in. That's it for my presentation. I think I will invite in the AmCham team for questions, and yes, thank you.
All right, thank you so much. And I'd like to thank the team from Forvis Mazars for presenting this really intensive, informative session on taxes. So we would like to really get questions. Looks like some of them had been coming through into the chat, outside of those that are introducing themselves and their businesses within the chat. But and some of them have been answered. I see Rita, you're answering some. Thank you so much. And the AmCham team also have answered on the question that has the sovereignty bill. The sovereignty bill that is being tabled now, we will be able to give you another webinar for those who are interested. We are going to be talking about this bill because this bill is really going to affect a lot of the businesses when it comes to foreign money. So if you want to hear any information and have any questions about it, we'll be working with TESLAF next week, Wednesday, to be able to deliver that that information on that bill. I think, let me check if there are any other questions again. Somebody's saying, kindly throw more light on unnatured spirits. And then the other ones, Rita has been answering them, if anybody had. But if you have any questions, this is your time to put up your hand and you answer it or type it in the chat. If we don't have any other question, I would like that maybe we get a little bit of Major. For me, as on the AmCham side, I had a question. I think the question was on the non-business assets, but I think you kind of gave me an answer from the second route of when Rita was answering. She gave an answer, and because I wanted to ask if they're talking about non-business assets, the individuals that are supposed to file for withholding tax that they were saying, how is that supposed to work as an individual? Does that mean that when you're filing income tax at the end of the year as an individual, is when you are supposed to file for that withholding tax? When does that apply? And does that even apply? I think for me, this law is sort of, although they are saying non-individual, I think the law is sort of targeting business directors, really, to see that if you're a business and the director, some sort of in a way, but does buy a non-business asset, you have to kind of supposed to pay that tax or do that withholding tax that has been injected. So I just wanted to get some sort of clarification, because I think for me, the government is really giving itself a lot of work on trying to say non-individual tax. When does that person that is not a business supposed to be able to file their returns? And then number two, I think the way they are trying to do it, I clearly see it is going directly to the business, but it's still going to the business, but in a way it is targeting the business, the directors of the businesses. And I think another one that I wanted clarification on was more on the revenue for an VAT, where you are supposed to deregister yourself, and you're saying 250, they have now moved it to 250 million. It was 150. So for example, 250 million, they are saying there's no clarity on when do you deregister? I think for me, I wanted to get clarity on that. When do you deregister as a business? If your turnovers are not being made, you're not making that thresholds they are throwing up. When do you deregister? And I think, again, the government URA is giving itself a little bit of work, because before you deregister, I can guarantee you they are going to try and do a little bit of audit on you to see exactly if you've been making 150 million, how come you can't make 250? You get me? So I just wanted those two clarification for us to be able to get that on my side.
Thank you very much, Eve. I believe I've taken note of the questions. Maybe you'll help me repeat the second one, but I can address the first one and the third one. You're asking a bit for clarity in regards to the non-business asset. So at the moment, with the wording they've used in the Act, they've not described or defined the asset. So we think part of the problem is that lack of definition of the asset that is going to bring people on board, because there is a school of thought that says non-business asset could mean an asset used in business, but that an asset held by a company but not used. Or it could mean an asset that is held by an individual person. For example, in your individual capacity as a director, as an employee, as a parent, or as wherever, that could be what it means. That if you have an asset held for use, ready to be used, or is being used, and you own it, that could be called a non-business asset. So of course, as you've indicated, there's a lot of ambiguity And if the parliament does not come out to clarify this, it means randomly as you're walking on the road, the URA and their crew can stop you and say, give us the evidence of buying this watch. And you would say, oh, I bought it from Rita. So Rita didn't give me a receipt. Now, casually, these are things that are feasible or are always fine, but now these are things that are going to be queried. In sense, they're also saying, do not move money around without giving us the cut, because from a principal benefits perspective, the government has made it possible. So they have to collect a chunk from every single time you transact. So whilst there may be a rationale for them, I suspect they need to clarify so that we know that they're really looking for the land, maybe that anyone selling land, and let's say it's family land, it wasn't business land, do we have to declare and pay the taxes? The answer most likely is yes. I believe they are targeting such things. So we have to be mindful. They may not be targeting everything, and the things they're targeting, they are not clarifying them yet. So that is something that we shall also need to seek from them. So in terms of which person, at the moment, it looks like it's targeting every person minus a company, a partnership, and a business. Meaning my individual capacity, I may be targeted. I suspect if an association, if you're a trade association and you're not making money, you're not in business to make money, you're not running any business, then you may be the kind of person they're also targeting. If you're, let's say, an NGO that's not registered as a company, if those are still there, then you're the kind of person that they are targeting as having a non-business asset. So we really need the government to clarify on this one. Now, the third item you asked was on what happens if I'd registered for VAT because I just hit my 150 million mark, and now I'm now doing 160, 170. I'm very far away from 250 million. So the law allows you immediately when you are below the threshold, you apply. There is no particular rule of when you have to apply. If you turnover and you actually anticipate from your transactions that you cannot make a turnover or the taxable sales of sales worth 250 million, you apply for deregistration. Now, I'm saying it this way, but it does not mean it will be very simple to manage at the URA. You may get a bit of hardships. They may ask you for the contracts. They may tell you to wait until that time has elapsed. They may toss you around sometimes asking for this clarity, or it may even trigger an audit on pay as you earn, which had nothing to do with anything. But the process has to begin. If you want to deregister, you apply online. They may invite you, or they may even come for an interview. They look at what's going on, what has happened. You give them clarity in terms of the change in terms of business, and maybe now why the law does not affect you. And that should be something they accept. So legally, it's something they should be able to approve. In practice, things may not work as swift as they sound, but it's now provided for. Do not wait for anything else to apply. So maybe, I don't know if that addresses the two questions. You may help me clarify the third one.
I didn't have the third one. I think it was on those. It was on those two, and or maybe the others here. I can see Rita is doing her best on answering them. Where I think Hank wanted to find out, and he said, "Let me just read that. Maybe also, Major, you can have a point of where you want to say something. Could you please provide more information on the proposed dates of the various amendments?" Okay, Rita's answered that. And then also Rita's answered, I think Hank, I wanted to look at Hank's question, where he was asking about the foreign person. Just give me a minute.
Okay.
Yeah, Hank was saying the definition of residence, does that include foreign residents? Question specifically pertains to the foreign source income. And I think Rita has answered and says a resident individual is the person or Ugandan or foreigner who has spent about 6 months in Uganda, have a permanent home in Uganda, and spent an average of 122 days for each 2 preceding consecutive years. Maybe you can give some bit of light on that as well, Major.
Okay.
But that's
For
what
the
I wanted to
residents,
ask for. Yes, for the residents on what did you call it? I think it was on a foreign
uh,
source income.
if
So
if
foreign
your volume is very low.
oh, sorry, you can now hear me?
Yes, yes.
Yeah, so it was about, he was asking about the foreign, on the foreign source income, that is the definition of residence. Does that include foreign resident? The question specifically pertaining foreign source income.
Okay.
Because, I mean, how do they determine you now qualify to pay the foreign residence income?
Okay. So
Yeah.
thank you very much for that. And and also for the other questions, I think I'm also going to go back to address the other questions that have been listed up. Now, particularly for this one, a resident typically is any person who is physically in Uganda and has a home, a permanent home. We call it a permanent home. A permanent home in Uganda, that is, you can be renting, staying in an apartment, wherever it is, for more than 183 days. And they don't have to be they don't have to be consecutive days, they can be cumulative. Meaning, if you spend 183 days in Uganda, you are a resident. And also, the other alternative that can be used to determine if you're a resident, and doesn't matter if you are born in Uganda or you're a foreigner, if you spend 3 years in Uganda, if you spend 122 days averagely for a 3-year period in Uganda, then you're also a resident. Now, that is one of the most obvious steps, meaning for the most people we have or we know that are in Uganda that have taken up employment, even when they are citizens of other countries, they are tax residents here. So to differentiate the two things, resident is just a tax category. The tax residents we're talking about is just a tax category, which has nothing to do with your civil right and obligations from the other countries. So your citizenship remains. Let's say you're American, you always remain an American citizen. If you're French, you remain a French citizen. And also, you may pass several tests of residence in other countries, and also meet tax residents in Uganda, because we don't have exactly the same rules. So for guidance, if you have income and you want to know if you should account for the income in Uganda or not, always look at the number of days you've spent in Uganda. If you spend more than 183 days in 1 year, or averagely for the last 3 years, you spent 122 days, then you'd have to account for the taxes. It means you're a resident Ugandan. Everything you earn out of Uganda should be taxed in Uganda now. If it's taxed already outside, the top-up tax is what the Revenue Authority can get from you.
Okay. So I think Hank he has gotten a bit of clarification. Rita is doing an amazing job on trying to answer a lot of the questions in the chat. Unless there's anything that has not been answered. I think there was one I didn't see.
Maybe, Evelyn, I could also, let me also address another question that I've seen maybe was not yet answered. It's on from Winfred Namfka. She's saying, kindly advise whether withholding tax on public entertainment is applicable if amount is below 1 million, and also if a company is not a withholding tax agent. So this one, the way it has been drafted so far, we believe it's that in terms of drafting, and we don't want to point fingers, but the government was a bit lazy. They've identified the category of people we should withhold from, but not on what. Now, this applies whenever it's obvious the kind of thing that you have to pay the person is one way. So to explain this better is that imagine I'm also a public entertainer, that on the weekends when people have weddings, I'm a public speaker, I'm an entertainer and a comedian. And people pay me money for these things here. Now, on Monday, I show up at office and I'm still the public entertainer because people still know that I do public entertainment. When I show up on Monday, the expectation is that whenever they pay me salary and I'm a public entertainer, they have to deduct the 6%. There is nothing that is, they've not indicated what they are paying me for. It means every single time a payment is made to me, tax has to be withheld. So we believe that's an error. They should clarify that every payment for public entertainment or for the following items, and then you list music, comedy, dancing, drama, videos, bloggers, vloggers, whatever, all that category. You list all of them, and then you say, for people paid this for these things here, maybe including this and others in this category should be subjected to withholding tax. Now that should be step one to say they fix the problem. So Winfred, the category is a bit open, but there's no threshold. So any person that you're paying, if they're a public entertainer, deduct 6%, regardless of whether you are an agent or you're not an agent for withholding tax purposes. There is no threshold for 1 million. The 1 million threshold only applies to other services. And that's why we believe this law has not been coordinated well to cater for other laws that are around the same concept of withholding tax, because this is going to be a problem. Thank you. I hope that addresses the matter.
Yes. All right. So I think we've kind of had enough questions. The last one, somebody's asking, what is the tax rate for the proposal for non-business asset disposal? If you look at it, Major, if you look at it, it's like one of the last questions. I think we'll take that as the last question. There's a very last question. If we can be able to be able to answer the very last question, and then I think we shall be able to close off. After that, but I would like to remind members to look at our feedback form and be able to fill in that feedback form for us so that we can serve you better on our next webinar. So, but go ahead and answer that.
Okay. If you're very low, I must insist, but on this one, what I've had, one question is not yet addressed. So, what is the tax rate for the proposed non-business assets? Now, the non-business assets are going to be taxed at the same rate as the property income. So, non-business assets, the disposal of non-business assets is going to be taxed under property tax as property income. So every time you sell, let's assume the law has gone through and you sold, let's say, your mobile phone, you'd have to go to the property income, include the sales, and then you sum up all your income, which is including maybe business income, employment income. The result you get, you subject it to 30%. So that will be 30%. Now, when it comes to the transactions for withholding tax, it's going to, the asset may be, I could just confirm that the rate that is applicable is going to be, I believe, 6%. Then the other question that's not addressed, I believe this is coming from, is this from Grace? Kevin, Okay, so Kevin asked a concerned about the environment by increasing environmental levy. Ideally, as they increase taxes on old cars, they should reduce the CIF on new cars to encourage people to buy new cars. Well, that's a good one. So this is more of a policy. This is more of a policy issue. And again, I may not be the best person to address this, but what the government is looking at sometimes is if people are really buying cars and in the habit of buying cars, we can put a small, and let me not call it small, we can put tax to it and we shall collect revenue good enough to help us run the country, improve the roads, improve the hospitals, and fund all the infrastructure that is needed in the country. So that I believe the government would have. However, I'm not privy to the discussion on why they are maintaining the CIF for the new cars at a very high rate. That is something that is best, of course, addressed by the government. And maybe that's the feedback I'll give for now, tentatively.
All right, Major, you can hear me now properly? All right, so I would like to thank everybody for having been here today, and most especially our colleagues from Forvis Mazars. Thank you so much for this insightful session. People are asking in the group, are you able to share the presentation with them from the emails they submitted So we'll be able to share that for those who did the registration, but we'd like to
Yes.
thank everybody. Go ahead, Major.
So I believe we'll be able to share the presentations. What we can do is we're going to just organize it so that we can put some little more notes for the users, because they are summarized for presentation purposes. Sometimes it may not be very helpful, but we're going to put some little information in there to guide the whoever will be looking at it. And then we can share it with you and you can circulate it accordingly.
All right. So thank you so much. Thank you so much, Major. Thank you so much to the entire team of Forvis Mazars for having done such an amazing job on this presentation. We would like that for those who have registered and you're able to be here today, we'll be able to send that presentation to you when the Forvis Mazars team has added in some other notes to it. But we thank you so much. Our next webinar is going to be next week on Wednesday, and that is going to be on the sovereignty bill. So for those that are interested in understanding what that bill is going to be, please don't hesitate. We'll be putting out the registration link today, and you're able to register, and we so that we can get insights on that bill. And particularly for us, we are focusing on it on the items that are going to affect businesses, and mainly those that are working with foreign companies to be able to receive money in Uganda, those who are doing investments with other partners around the world. So we'll be able to give that information clearly with our partners, who's going to be TASLAF. So again, thank you so much, and enjoy the rest of your day. And we'll see you again next time. And look out on our social media pages and our website for any of the other activities that the chamber is having. We always have different activities that are educative that you can be able to benefit from. So thank you so much for joining us. Have a lovely day, and please don't forget to feed in our feedback form. So thank you so much.
Thank you.
Thank you very much.